Okay, the bottom is in. That's the message, right? That's what we're hearing a lot of right now. That's what the big question is. Is the bottom in? I mean, how can it not be after such 2 days of strong rallies? So we're going to break that down and see if that's actually the case. What kind of markets we're in right now, what the indicators and charts are telling us, and about this price action that we're getting, how bullish it's been. Has it been, like I said, has it been bullish enough to change, to get us out of this weakness, to be more than just a pullback? So I'm going to break that down. We're going to take a look at what's driving the price action. Some interesting moves today. Some really interesting moves today among all the different asset classes. And we're going to take a look at the risk trade from multiple ratios to see, especially from a U.S. sector standpoint, whether whether we have been in a risk appetite mode, or if this little selling has actually coincided with a risk aversion mode. And then what does that lead into now? Especially considering, again, 2 days worth of big rallies. So I'm going to put all that into context, and then we're going to take a look at a stock that's a big bellwether company. We're going to talk about how we might be able to trade it with the pattern that it's getting, especially in light of all the other trades that a lot of bearish trades that we've been putting on in our class portfolios and previous market outlook videos. So we're going to add a little something positive to the portfolio, and we'll talk about that. So let's go ahead and get started. Today is Monday, January the 31st, 2022. This is the market outlook from MarketScholars.com. My name is David Settle. All right, let's go ahead and take a look at the S&P 500 with the market forecast indicator. A couple of good things occurring here. First of all, we've retraced now 50% of the decline, including last Monday's low point, that long lower shadow. So we haven't quite obviously we're not back above the moving average. We're not back above that 62% retracement level either, which is going to be an important resistance level. And remember, the new bullish trend doesn't start until you're up above that 46.90, and we hold that. But a good sign that may be the case here is that you have your near-term line jumping up above the 90th percentile. That doesn't guarantee that we're going to rally up. Like I said, we actually got it right there too. Now, we didn't get the momentum line up to extreme highs. It did get up to the 90th percentile the day before, but the near-term line did get about to where we're at right now on that day. And we were actually above the moving average on that day, and we had a nice good rally off that low, but then we came right back down. So really important to see how we follow through on this one, to see if we stay in the reversal zone. You can see we were already back out of the reversal zone the very next day. In fact, the very next day, we were back out of bullish territory. We dropped to 52. So we were just like that, back out of bullish territory. So that can't happen. It's one thing for the momentum line to do that, the red line, but not the blue line. We are still almost 2.5% below the moving average. So we're actually still pretty significantly below the moving average here. If you look at the NASDAQ, you see it's just barely jumped above this 38% retracement. Now it's a good rally too, but it didn't quite get up above the 90th percentile. Got to the 87th, big extreme high. The intermediate line is just barely getting above 20. So, and we're still below. Market sentiment's actually in the neutral territory, whereas with SPX, market sentiment's actually just barely below the 60th percentile. So very similar pattern. Looking at the Russell a little different because we never did get this was never an intermediate rally during the Christmas week like it was for the other indexes where they got new highs. So this is actually one big long intermediate run because the intermediate line never did get up in bullish territory. So we're actually not even above the 23% retracement. And remember the 38% retracement level is actually is right at that 23 of the long-term move of the post-COVID rally. That we had dropped below. So, and then you can see short-term sentiment not nearly as bullish, even though it's a great update, 3% rally. But again, what people don't get today is, when you have a lot of, when you have bearish moves, I think a lot of times, especially on TV, they think that when you're in bearish decline, when you're in correction, they keep calling this a correction, even though it's not a correction. I showed you that before why. But I think that the idea is when we're in a correction, then we just go down every day. And then once we stop going down, once we get a green bar, then that means that we're done with the correction. But the reality is, we all know that's not the case, right? You get green bars during that post-Thanksgiving Friday drop, we got plenty of green bars. We got one above 2%. We got above 2% on Friday, and this one above 1%. So you get plenty of green bars of 1% moves or higher. That's how these things work, and that's how it was today. You can see in IWM we actually got a 3% move, which is fine because we actually had a 3% drop to start this leg lower. And we had all these days of 1+%. We had a couple 2%ers. So again, a correction is not void of green bars here. You're gonna get big green bars. You're gonna get the biggest green bars out of any during any bullish run. I mean, look at these. During this bullish run on the markets with volatility really low, we didn't get hardly any big green bars. The last two have been bigger than any of these were. So I mean, that's how these work. Like you're not, just because you're going up doesn't mean that we're trending up. The same thing happens in reverse. When you go down, that doesn't mean that we've hit a top now and now we're going to start tanking, right? It's the same thing in reverse, right? You're just retracing, and right now we are just retracing. We had this discussion on the weekend. Why is this a retracement when we're not going down? Typically we retrace to the downside because what are you retracing to? What are you pulling back to? In this case, we're pulling back to the mean. The mean is that line right there. That's a 30-day moving average. It's the simple average of the last 30 days worth of prices. It's the mean. And so we're pulling back to the mean. When you move away from the mean, you pull back to the mean. And when you're below the mean and you've made a pretty directional move to the downside, then you're going to pull back up to the mean. And that's what we have right now on the S&P 500 and across pretty much all these major indexes on the market forecast indicator. Let's take a look at the weekly chart, and you can see the really bearish candle, very neutral candle so far. So that's a good sign. We're not back above the 50-day, but it's a good sign nonetheless. Same thing here on the NASDAQ. We got a upper shadow and a lower shadow, and on the Russell 2000, not quite the upper shadow yet. Still a bearish candle, still a falling PPO. Remember, the Russell 2000's got a negative PPO. We actually do have the death cross right now going on here. When you look at the 3 green arrow charts, 4 grid, there we go. Right there, you can see we have green arrows, right? So we have 2 green arrows here, we have 2 green arrows there, we have 2 green arrows there, and we still have 3 red arrows in the Russell 2000. So we're still not quite as bullish there. But remember, you don't have 3 green arrows yet. You have to have 3 green arrows to get the green shading. And of course, to get green shading in a green, it's one thing to get green shading in a red line, right? If you were to go, here, let's go back. Sorry, let's go back to this one. And if I were to go back to say 5 years, and you look at some of these levels, and you can't really look at COVID. So let's look at fourth quarter 2018. See, we had green shading here, but we didn't have a green line. We had a green shading there. We only had a green line for 1 day, and then we're back to a red line. So and back to clear. So it's one thing to get green shading when you have a green line. I mean, that's bullish. But it's another thing to get green shading and you don't have a green line. I mean, that's bearish until things turn around, right? And so right now, if we get green shading, it probably won't be too bullish because you probably won't have a green line there, at least yet, right? Obviously things can change and the trend can change eventually. But I mean, this great rally we had got us up to the 17-day moving average so far. I mean, it kind of held support at the point of control. We kind of bounced off it. They got a lot of long lower shadows, big ranges. We were trading below the 200-day, basically between the 200 and that point of control. We have now since gotten back above the 200 today, and now we're holding the 17-day. So remember, we just also keep in mind too about the S&P. We just barely got a death cross, or the 30 intermediate death cross, where the 30 cross below the 50-day. If you look at the NASDAQ, you can see that we are not above the point of control. We are not above the 200-day moving average or the 17-day. And of course, we already have the death cross there too. So, and we're just barely above the 38% retracement. So again, it kind of puts in context just how bullish we've been. Why have we been so bullish? Because we were so bearish. You're so far below those moving averages. That's when you are the most bullish. That's when you get the biggest bullish days, is when you're below, especially when you're that far below the 8-day. Right? When you're below these moving averages, you will get your biggest bullish days. And you can see the Russell 2000 is not even close to its point of control. It's way below its value area. It's way below these Fibonacci retracements. I mean, it's sitting at the 23. It's barely, but it's not even to the 17-day, much less above it. So, and that's, remember, you don't get a bullish divergence until your MACD is above its moving average and we're above the 17-day moving average. Obviously, that's not the case here. Right? If I were to go back to like even the COVID low point when we had, this divergence here, you had a bearish convergence for a long time because you couldn't get above the 17, and then there you finally got your bullish divergence, and we were off to the races at that point. If I were to go back to 2018, we had a few times of brief bullish divergences that turned right back down. Another one right there, and it turned right back down. So, it's we're not even to that point yet, right? We're still in. The MACD is actually still not even a red arrow on that. On the S&P, we do have the the green arrow. The MACD has jumped above its moving average, but we're sitting right at the 17-day. Let's look at some of these indicators. You can see the directional movement index. This doesn't look bullish at all. Like we're not below 20. We're still above 25 on the negative. We're nowhere near being above 25 on the positive. If you look at IWM, same thing. We're not below 25 on the negative. We're nowhere near being above it on the positive. And you look at the Qs, and again, we're not even below 30. We're not below 25 on the negative. We're nowhere near being above it on the positive. So we're still not there yet from a directional movement index of saying, okay, yeah, we're changing things around. We're still in the lower half of the chart on both of these, on the RSI and the CCI. The Russell 2000 is even worse. This is barely creeping out of bearish territory. And then your NASDAQ is also barely creeping out of bearish territory. Still easily both in lower halves of their charts. When you look at the directional movement index, SPY is still below its cloud. You still got a strong trend going here. Even with the rally, you're still below -5. You're still above 80. When you look at IWM, you're still below -5. You're still above 80. So you still have and you're well below the blue line there. The red line's well below the price. We're well below the cloud. And then looking at the Qs, you were still below -5. We're still above 80. And we're still below the blue line. And we're well below the cloud. And the red line's well below the price. So you can see how it's going to be really hard to change the trend. When you look at the Arun indicator, typically the Arun indicator bottoms out, or like we typically bottom out when the green line hits 0. And that looks to be the case in the Qs, that we might be kind of getting a little bit of a short-term bottom here. The SPY hasn't hit the bottom yet. IWM also hasn't hit the bottom yet. They're close, but they haven't quite hit that bottom yet. And we're not out of bullish territory here yet either on the red, on the Arun indicator, where we stay, like we're still above 70 in SPY. That's the closest one. The Qs and the SPY. IWM is still 94. So the Arun indicator, which is measuring how we're doing on this chart, is still not quite there yet. Higher high, higher low, closing above yesterday's high, closing above last week's high. So that's a good sign. The Qs, same thing, above last week's high, higher low. I mean, in fact, we gapped above yesterday's high and held it so far. IWM, we are not above last week's high, right? So we're inside of last week's range. We closed above yesterday's high, but we're still below last week's high. So still not that bearish yet on that chart. When you look at the trading range today and the volume here, you can see that the volume was again 151 million, above average, 151 million. The range also above average, but just barely. The average is really big now. 10 points. So when you look at these numbers here, 151 million is still off this chart for the 52 range. 10 points is still above the average, so we're still above that 2%. As long as we keep getting these big candles, we're going to have an ATR that's up in this 2+% range, right? And that's a significant level for the indicators. Finally, your VIX. We talked about the VIX not getting above 100 last week, and having that day where you close above 105 and close below. We're back now. We're back below 95. So we're again, we've done this before, right? You've gotten these kind of candles. You come back below this 95 level on all of these. So that's the case now, and now it's a question of where it's going to hit support. We're still above 20. Where is it going to hit support here? We are still. We've talked about this regime change on the volatility index. Here, let's go to the 2-line version. We talked about this regime change on the VIX. We're a little bit below the 17-day moving average there. The 50 and the 30 are rising up above the 200 after having been below it for this time. But if you look at the longer term view, you can see that we're still easily above the 17-week, and we're above all these moving averages. They've kind of converged. We've kind of broken to the other side of this 200-week, and we've stayed there so far. So that suggests that we will get short drops on volatility, but nothing, unlikely that we'd get like back down below to 50 towards 15 anytime soon. I also wanted to show you the SPX on this one because 2 weeks ago we talked about, after this week, we talked about that we would trade over the next couple of weeks in between the 50-week and the 17-week. Now that we've significantly broken the 17-week, we're probably going to trade within this gap between the 50 and the 17-week, and that appears to be the case. The MACD is still positive. It's still below its moving average. We're still below the 17-week, so we're still in bearish divergence mode. We haven't changed that yet, despite the bullishness. So that this will kind of give us an idea of how much bullishness we have left in the short term to the upside, because we're already hitting these lines. You can see again, getting back above the 50, getting back above this 23% retracement, still below the 17, and the Russell, remember, it's not even close to the 17. It's big time bearish divergence. And in the short term, maybe running up to resistance, but that's it, just in the short term. So what do you think? Do you agree with that? So again, my take on this is we've had a big bearish move. We're well below the moving averages, and we're bouncing back up to them. We've been talking about that for last week. We got a big move on Friday. We followed through on that today. I expect we'll probably get a little bit of a bullish rally tomorrow. Probably not the same size as what we've got in the last couple of days, but I expect it will probably be positive tomorrow heading into these resistance levels in the short term. But then I think that's it. Then I think we make a new leg lower, at least starting that leg lower by the end of this week. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. Let me know what charts or indicators you're looking at that suggest why you're either a lot more bullish than I am, which I can understand, but I'd love to see what's kind of helping you make that decision. Or maybe some of you are a lot more bearish than I am. You're not looking at just a little market sentiment decline. You're actually looking at like bear market decline. So let me know why that's in the cards for you in the comment section down below. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. One, you liked our video today. Two, you want us to do another video again tomorrow. It's a quick way to give us feedback if you like our stuff. Of course, if you don't like it, you don't have to click on anything. You don't even have to watch if you don't like it. Also, while you're down there, comment. What did you get out of the videos today? What stood out to you? What questions or comments do you have about anything I brought up in the video tonight? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, check out some of these other things over here on the right. You can see our Market Outlook live video. If you click on this icon, that takes you to this page. On this class, I do it at 3:30 Eastern Time on Monday, Wednesday, and Fridays. I do it live. It's done right here. At that time, what we do in that is we cover all the trades that we've done in previous Market Outlook videos to see whether we should stay in them or get out of them. And then we also put on today's trade idea that you'll hear at the end of the video. We already put it on today during this video here, during this class, before the market closed. So you can be able to check that out. You can also get to it by coming up here, clicking on Live Trade Review. If you click on Trading Rooms, that takes you to our calendar with all of our classes and recordings and upcoming classes as well. We have almost 4 years worth of recordings listed here, so you can check those out. Come down here to the bottom, hit that heart. We almost got 100 likes on Twitter. We're getting really, really close to getting 100 here. But if you click on that and hit that like button right there, also hit this thumbs up icon. It takes you to this page, and click that like button as well. Again, the more you do that, it really helps get our content out to more of our followers because of all the engagements. That's how their algorithms work. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you actually engage with. So we try to make it really easy for you to engage with us right here. All right, let's take a look at what's driving the price action today. And you can see one of the biggest movers, obviously equities were all high. The Qs, IWM, emerging markets all rallied hard today with the dollar up the dollar down today finally. Let's zoom out a little bit and just go to the month. So remember the market, the years started with a rally, but he actually had an update. So I'm going to go forward one day to when we started to decline. So this is where we really started to falter. You can see emerging markets are not really down that much at all, as the dollar is actually, even the dollar is slightly positive, and it's been kind of flat. Even with the last little rally it's had, it's been relatively flat for this year. Same with gold, same with long-term bonds. You can see why the Qs and IWM were so bullish, especially these last 2 days, because they had been so bearish. I mean, down 16, 15, 14% here for again, not from the end of last year, but after the first day of this year. And then emerging markets were only down about 5% going into Friday, and then of course now closing that period relatively positive. So you can kind of see what's been working, what's not been working. Look at commodity prices, really bullish. So let's take a look at how some of these charts look like. Let's start off with the dollar, and you can see. Remember how we kind of talked about this. At least we talked about this in class about. I think it was our Thursday portfolio management class. We kind of talked about the possibility of that dollar rally being a little bit of a blow off top. And you can see now that's kind of playing out as we got this, it was a big move. We'd already been so bullish, and then with a big gap, and now we're filling in that gap. So you can see the dollar's starting to pull back a little bit. Commodity prices, you can see, have been grinding higher. We still don't have even a convergence going here yet because the MACD is still above its moving average there. The histogram is still positive. We don't have that red arrow yet there on the histogram. Let's take a look at long-term bonds. Long-term bonds have been converging, right? We have, the MACD is above its moving average, and you notice we're still below the 17 days. So we haven't really been able to get going yet to the upside with a bullish divergence on long-term bonds. Of course, the 10-year bond, which is actually, again, more obviously a little bit more closely tied to the Fed funds rate, that one's really been bearish, and it hasn't even been able to get close to the 17-day, even though, with the MACD already above its moving average there. Of course, your short-term bonds are getting hammered. They're the ones that are obviously a lot more closely tied to the Fed funds rate. They're trying to diverge and trying to base out here on the MACD, and we're still way below the 8-day moving average, so nothing even close there. So you can see why TLT relative to SHY, if you were to look at the relative strength here, let's go to the relative strength chart for that. For TLT relative to SPY, and you can see that TLT had been underperforming because yields have been rising, long-term yields have been rising. They had been underperforming here, but you can see that that's no longer necessarily the case. Like, after this big underperformance since pretty much the COVID low point, long-term bonds really underperforming relative to cash, which is what SHY is, 3-month, 1 to 3 month. If I were to zoom back in now on that 1 year, you can see that's the 200-day moving average that we're flirting with. We had been above the 50, we had been above the 38 and 17. We dipped today below the 17. We'll see how temporary that is, to see whether or not TLT bounces right back up above the 50 and gets going on this bullish divergence. See, the MACD is up above its moving average, up above 0. One little day below 17-day. Now let's see what happens with that. It's, you're pretty bullish on a lot of these indicators here. Your positive indicators still easily up above 25 down there, and your RSI still in flirting with the bottom of bullish territory. So I think long-term bonds are trying to base out, bottom out, and potentially move higher. Gold obviously is a topic of a lot of conversation. It's pulled back with the strength in the dollar recently, but it's pulled right down to some really significant support with the opportunity for it to bottom out. You can see Bitcoin is still very strong trend. MACD is above its moving average, but you're still easily below the 17-day moving average, and that's on the daily chart. Of course, your weekly chart, we are, the 17-day we're well below the 50. We're well below the 17 week, excuse me, and we're filling in the gap between the 50 and the 200 because there's very, very little volume. There's a little bit of volume here, a little support at the value area, but after, as well as that 62% retracement. But after that, 20,000 is well within range for this to get down to that. That would pretty much cut it in half from where it's currently at right now, and much less, from the $70,000 high that it was at previously. Let's take a look at the major economies and how they're doing. Let's see here. Let's go over here to this one. Let's go to the comparison first. And again, just go to today only. China, almost 5% rally today. Big move. That's why emerging markets are so bullish. And you can also see, UK lagging behind, France, Germany, all your European developed countries lagging behind. Brazil also lagging slightly behind there, but you have India up there on the top, South Korea up there, Russia. So all your major, the biggest economies in the emerging market space, all really rallying significantly. You can see what it looks like here. China's above its moving average. India is above its moving average. Russia's still figuring that out. South Korea is coming off of a cluster. Brazil is well above its moving average. So much better picture that we're seeing here on these major emerging market areas versus, say, some of these developed markets outside of the UK, of course. Let's take a look at the U.S. markets and take a look at how the sectors performed here today. So we'll come to this chart first. And again, just look at today alone. And you can see discretionary is a big winner. Tesla, big name in that space. Big winner today, almost 4%. Technology up 2.5%. Communication. I mean, this is QQQ from a technology space. But interestingly enough, look at utilities up 2% today. So not a significant sell-off. In fact, energy was your biggest seller. Now remember, let's go back out to that January the 4th when this whole period of weakness started. This is why energy is struggling, right? Because energy's got, has already had a good month. It's very significant outperformance relative to everybody else. Nothing else is even close. You got a couple safe haven areas that have been holding up well, and you can also see why discretionary rallied so much because it's got the most to move to the upside. If you look at, its chart in terms of being below these moving averages, it was way down here. It still is below its 200-day. It's still easily below its 50-day. If you look at technology, it's a little bit higher. Let's go to this chart and let's take a look at discretionary relative to staples, as a sign of risk appetite. Look how sold off that is. And so, there's a long ways to go here for things to kind of turn back around in the direction of risk appetite. Here's the PPO turning negative, long-term PPO turning negative there. Here we can even go back to the 50 and 200 week PPO. You can see we just barely got below the moving average, and we're below the 17 week. Now we're not below the 200 week. The last time we were was 2020, of course, and if you go back to like some of these other periods, 2016, 15, we got below there. Fourth quarter 2018, we didn't. And so you can kind of see just how significant this selling is, but also how much we have to be how long we can be bearish. That PPO is really high, about as high as it was in early 2018 or fall 2018, where we basically went on a little bit of a risk-off mode for quite a while. And you can see the RSI or CCI is bearish. The DMI is bearish. A big breakout on the weekly DMI. The RSI is bearish territory. So from a risk-off standpoint, you can kind of see, what's working here. How risk appetite is moving. If you look at the same kind of relationship, but in terms of interest rates, right? These are both very interest rate sensitive sectors. Utilities have been underperforming financials this entire time because rates have been, the yield spread had been, doing relatively bullish until just recently. The yield spreads appears to be kind of rolling over. And you can see that utilities is trying to get back up above financials, closing above all these moving averages today. Obviously still well below the 200, but you can see it above all these moving averages. And its PPO of this long, this is the 50 week, mind you, not just the 50 day, but the 50 week, and then there's your 200 week. You can see the PPO is really low, and the histogram is almost bullish. So we're getting a little bit of a crossover in this point, and a move up in the positive territory for the MACD for the relative strength, as well as getting out of bearish territory for the RSI and the CCI. So from a risk appetite standpoint, we are, gravitating, kind of rolling over towards broader risk aversion when you look at it from a U.S. large cap sector performance and relative strength. All right, so for our trade idea of the day, I wanted to add something a little bit because we've had so many negative deltas in our portfolio. I wanted to add something with some positive deltas with today's rally. If today's rally turns into something more, so I wanted to look at something that had one of the more bullish looking charts than what we've seen out there, and you can see that on Apple. Apple had a pullback. It pulled back in to the Fibonacci retracement zone, hit the 62% on the low of that day on Monday. Since then, we have rallied up pretty sharply back above the 30-day moving average, which not all the indexes have. The near-term line spiking to the 100th percentile practically. Very, very bullish near-term rally. Very bullish move back above the 23% retracement. So really good opportunity from that perspective. When you look at its long-term chart, you can see that it's, again, we had the long lower shadow last week. We don't quite have well, actually we did get a green arrow last week. So we got a green arrow. We got a positive differential. We don't quite have actually we do have a rising PPO again, just barely by 0.02 of a point, but we have a rising PPO again there. If you look at some of these other indicators, some of these other oscillators, there we go. Apple, the positive directional movement index is up above 25, even though it's not a lot, and it could just bounce right back down tomorrow. But obviously, we are very well positioned for that from a broader standpoint if that were to happen. If not on, if we wouldn't be necessarily on Apple. This jumps right back above 50, almost back above 60, easily back into the upper half of the chart on the CCI as well. When you look at the trend strength indicators that had been bearish, now not so much, right? We're back below -2. We're back below 65. So now we're back to a weak bearish trend. We're actually back up above the Ichimoku cloud. So very, very good moves in this context here for this stock. One of the better positions that we've seen from a bullish standpoint, because everything else is still below their moving averages. So you're almost right back up into the upper quartile. With a big bandwidth too, but you're already back up to the upper quartile, and we're above the value area. We got back up above the value area. You can see we hit it on the Fibonacci's level, and then bounced right off of that. So really good bullish especially on a relative basis, really good bullish chart on Apple relative to a lot of the other opportunities. So, but again, we don't know how bullish we are from a broader market standpoint. So what we decided to do here was to do a bull put spread. So we come down here, sell it was mid-30s delta at the time, the 165 strike by the 160, trying to get at least $1.16. I think we ended up getting $1.15 out of it, and so roughly about 30%, about as close to 30% as you can get without quite being right above it. So normal position size, and you can see where that break even is. If I put that break even on the chart here, and put it right here on the chart, you can see it's back below this move. So if you take a look at it from this perspective, Apple, we'd have to get all the way back into that post earnings gap for us to get out of it, which is good, because if we were to start filling in that gap, it's going to be pretty significantly bearish again. We want to be out of it. But higher high, higher low, closing above yesterday's high and last week's high in the upper half of the 4-week range. I mean, very, very. if you look at the Arun indicator from when you're looking at it this way, your positive has almost gotten down to zero. But your negative is falling really sharply, and that things are going to change very, very quickly, considering how high it is. Like I said, already in the upper half of the price itself, already in the upper half of the chart. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's threads. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, as well as our website at marketscholars.com. Click that thumbs up icon. Like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your Monday night, everybody, and we'll see you all next time.